Okay, guys, welcome to today's video, and today we're going to be talking about how to avoid missed entries, right? How to avoid missed entries in trades, right? When we are trying to look for a trade entry, right? How to avoid it. Now, there are some certain setups you have, right? That the market, no matter how you look into that, you would still miss entry, right? And most times, because of volatility of that particular pair, you can end up missing entry, or you can end up being swept. Your stop loss can be, if it's very tight, it can be swept. There are certain situations like that. It happens in the market because we can never be 100% correct. We can never predict or analyze the market 100%. We cannot catch every move. So it's very important as traders we understand this, right? That no matter how good you are, you can never be able to catch every move in the market. There are some moves that your eyes would not see it. It is after it has happened then you see it, right? And there are some moves that no matter how you analyze the chart and you're waiting for that setup to play out, it will either fail, hit stop loss, you lose that particular trade, or it will miss entry, right? But there are situations whereby you continue missing entry over and over again, right? In order to avoid that, that's the essence of doing this video, so that you know that, oh, I know that I did everything I know, right? I did every justice to this analysis and analyze this based on all the confluences I can see. That is how you analyze. If it plays out good, if it plays out the other way, you wait for the next setup, right? You recess, have a recess on that trade, and you wait for the next setup. Now, I don't want this video to be too long, so just be brief, right? Now, we should remember that whenever we are remember what you're trading, right? You're trading SMC, smart money concept, right? And if you are trading smart money concept, you should be trading smart money concept. Don't try to mix it. Don't try to, uh, how is it called? Force the setup. Force what you want to look for, because you're looking for smart money. You want to force it. If you're not seeing it clearly on the chart, you just go and do another thing. Let more price action print. Now in SMC, we pick our entries on lower time frame, and what we look out for are called point of interest, right? It means certain zones we are interested in taking a trade off from. And in order to pick a point of interest for our entry, there are some certain things we must see. I've discussed this in the past, right? In a past video, so I'll just be introducing it, right? Whenever we want to pick a POI, POI here means point of interest. It means these are zones or regions we want to pick a trade from. There are things we must see, right, on the chart for a particular point of interest to be valid for us to take that trade, right? And the number one thing to look out for is that the point of interest, right, that you are going to use for a trade must be the point of interest that is near liquidity, right? So there must be nearness of liquidity to that particular point of interest. That point of interest should have liquidity close to it. So if you have several points of interest and price is coming, right, the first point of interest you want to be looking out for is the point of interest that has liquidity close to it, either up or down, right, depending on the market structure. This is one thing we pick out when we look out for before we look for a point of interest we want to take trades off on lower time frame. Okay, liquidity. So that point of interest must be close, or liquidity must be close to that particular point of interest before you take that particular trade. So there must be liquidity available, because you know that liquidity helps as a fuel that what moves market, right? So you want to have liquidity to take and liquidity to target on that particular time frame entry, which is smaller time frame now, which the particular time frame you want to use for that entry after doing all the necessary analysis. So that is one thing we look out for before selecting our POI. Of course, you know the rest, structures, break of structure, and the rest, right? That particular point of interest must have done one or two things. So that's sweep liquidity or break structure. Okay, so we don't want to dive into that part. Now, this point of interest, right? We have discussed three several types that we look out for in respect to. We have order blocks, we have what's it called, breaker blocks and mitigation blocks. You guys confuse that. Mitigation blocks, breaker blocks. You guys confuse that. I think I'll just find a simple way to teach you guys what that means, right? Let's see. I think I dropped a trade setup yesterday, the one I took on ETH, and a lot of people were kind of confused. They're still confused about what mitigation blocks and breaker block means. Just like the name implies, breaker, a block that has broken structure before, right? That has now been violated. If this guy has taken out a previous high with a body close, and all of a sudden, market just come and take out this guy that has broken structure before. This guy here is now called the breaker block, right? Same thing, right? Same thing in the scenario. This guy broke structure, then all of a sudden, let me put it the other way. Okay, where's this? Let me take this out. So let me put this break of structure very clear here, so you guys understand. Where is it? Okay, POS. So this is in relation to whatever time frame you're looking at, right? Remember, if market has broken structure like this is a swing low, this is a swing high, right? So if market is coming, we're expecting market to retrace into regions, right? Then buy. Okay, but now when that does not happen, then you see market just take out this previous low that has caused a break of structure, right? Now it is this guy that's now called a breaker block. The other block that broke structure that market violated again is now called a breaker block that price can use, right? Price can use for entry to the downside. Okay, this is that particular scenario, okay, of breaker blocks. Now for mitigation block, just a quick example. There is a block here. This market came to this particular resistance and started pushing up, but could not violate this previous high. It could not violate this high. It just makes a move like this, then breaks to the downside, right? Makes a move like this, breaks to the downside. You get that one did not create a break of structure. It did not create that break of structure, right? Creates the move to the downside without creating a break of structure. So a clear example I'm going to show you on charts so you guys understand very well. So now point of interest we pick, remember we said what? Order blocks, breaker blocks, mitigation blocks. Those are the point of interest. So if you don't know which one to pick, that's where missed entries come from, right? Because the price action will not be as neat as this or as this, right? It will not be neat like this. Okay, if we do not know which one to pick from, you'll be missing entries because you might have a mitigation block there while you are aiming at a particular order block, right? You might have a mitigation block and you're aiming at that mitigation block or a breaker block, and that particular breaker block has been mitigated before. Then you enter a trade, the market just moves a little bit and started coming back to the order block, takes you out and comes and buys or sells from that particular order block. Why? You do not know how to select that particular breaker block. So the trade I took on ETH, I shared it on my timeline. A lot of people were confused about that. I'll just explain that so that you guys will see how I took that particular trade, right? And most times when I even post all those things, it's because, and you see me mark out zones, it's just because I just want to educate you guys, some people, right? Most times I don't really mark, so most times I just mark out zones because I want to educate. Okay, so now like I told you guys, mitigation blocks are basically for continuations, while breaker blocks we use it for reversals. Because now look at this market structure. Market was bearish. We had this move to the downside, right? Low created this low. Market shifted structure right here. a pull down that could not break to continue the move. Market stop. So you have something like this: a low, a high. Market was supposed to continue bearishly, it could not. Right? It stopped here, then it broke to the upside. So you have something like this. Now, you cannot call this a breaker block. It did not actually create that break, right? It mitigated this particular order block and rejected. Now, this region, right? The last, for it to be bullish, if the structure is bullish, the last bullish structure here, right? The last bullish structure before market started retracing is now called the mitigation block. You can see there is no break. This block here did not actually break any structure like this that will now call a break. We'll now call it a breaker, right? It did not. All it just did was mitigating this previous order block, right? That's why it's called mitigation block. It did not break, right? It mitigated. It tapped into this order block right here and shifted structure and continue the shift, the movement to the upside, right? So it's not even the first move. Market have shifted here. This one just continued that move. You can see it here. So the last bullish candle before, right? The last bullish candle before market retraced down, mitigated this order block, then break, can serve as a mitigation block to continue moving markets to the upside, right? So if you look at this very well, you want to understand what just happened. You can see when market was moving all the way up, right? All the way up, you can see where the shift happened, right? Market structure shift happened, then market shifted down but could not take out the previous low. You see the last green candle here, right? The last green candle before market was retracing to mitigate this particular block here and broke to the upside can now serve as the mitigation block. You can see market did not even violate that particular block, right? But there must be a form of liquidity before you take a trade in order not to be induced on the market, and this region should fall, right? It should fall inside the discount, right? You can see it if you mark highs to low from this swing high to swing low. You can see the 50% region is just resting in the mitigation block, right? If the 50% region is not here, you're not to take that trade, right? You're not to take that trade. If you look at a mark from this swing low to this swing high, market was retracing. You can even see that how now you now also watch the reaction of market. You see it's right at this 50% region. Now you now watch the reaction of market, that you now know that structure wants to shift. If you look at this, right, you see impulsive moves. When market was coming down, you see how many green candles would you see moving to the upside? You see plenty green candles. That's a retracement. Then all of a sudden, one, two, three red candles brought the market down. For market to move up to this level, you can see how many green candles moving slow but coming down, impulsive move, moving up, coming down, impulsive, moving up, slow, coming down, impulsive. But now moving up at this region was impulsive. Then can you count how many 1 hour candles were printing for markets to be coming down? That's to tell you that, oh, the sell pressure is shifting. Market has shifted structure here again on this high time frame move. And what sell pressure, these are reactions. You now also you now be looking at only 1, 2, 3, 4 1 hour candles took market up to this region, but now it has printed 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, more than 20 something candles moving slowly to right to the mitigation block. That's to show you that, oh, sell pressure is reducing, right? And there will be a form of liquidity. You can see you can see structural liquidity here. There must be a form of liquidity, either structural or induced, on the move, something like this, right? That's why I taught you guys liquidity So when you have a move like this, right, mitigated, so you can have a shift like this, a little structural that creates those internal move, right, before market coming back into the mitigation block to buy. You can have it like this, right? If you see the one I marked for my trade entry, when I was analyzing the trade, I marked this move here. This first pullback, when market moved up, this first pullback was what I marked as what? Liquidity, right? Market pulled back and made a move. And if you even go to lower time frames, you will see another structural one. When market broke aggressively, you can see the mini gap. There was also a structural liquidity resting here. There must be something like this. If not, you're going to get induced, right? You're going to get induced. So structural liquidity should be there. If there's no structural, market will create engineered close to that point. So it will not just break with one candle and come back with one candle you want to enter. It will now induce something like this, engineer something like this, then comes back down, then you want to buy, right? If there is no form of structural liquidity while the market broke out. But you can see this when the market broke out aggressively, you can see the candles, right? From this, you can see that structural move moving up. Then all of a sudden, the market started moving slowly, took out the structure, tapped into the POI, right? Then you saw that reversal move to the upside. So that's how you pick a particular POI. Liquidity must be resting there. Now, situations like this, where a lot of people missed entries, some situations, market will never make such move, and you'll be waiting for. I think we have talked about different scenarios where you'll be waiting for market to come to a particular order block, and market will not even buy from the order block, even on smaller time frame when you go for time frame entries, because of all this. So if someone had gone to a smaller time frame, say 15 minutes, and want to pick entries, right, without giving attention to this mitigation block, what would happen? You'll be marking this 15 minutes order block right here. And of course, is the order block wrong? No, it is not wrong. There's even if an FVG here, right? Do I even call that an FVG? There's an imbalance right there resting on this particular order block, right? So if you mark this order block now and you are desperately waiting for ETH to come to this order block, it won't get here, right? It will not get here because why? There is a mitigation block right here. There is a structural liquidity right there. So this is the first POI that is nearest to a liquidity zone. So the market comes back to that POI, it taps it, rejects, right? This your POI now. It will keep it there maybe for another time. Maybe for another time. So you'll be like, what happened now? I've marked my swing high, my swing low, and there's an FVG. You now mark here. You now say inducement, or what we call it. You now mark here and say fair value gap or imbalance, and you'll be waiting for market to come to tap into your entry. You put your stop loss here or below the previous swing low, and you'll be like, damn, missed entry, market did not tap into my entry. Why? There was a bullish candle here that market created before market started coming down. Market broke out from that. So that region, right, was now the particular POI that was near to liquidity, and market did not even invalidate the POI, or market accepted this POI to push price upwards, and you be here waiting for your entry, and it will be a missed entry. Okay, it will be a missed entry. Is it wrong? No, you didn't do anything wrong. You were analyzing, but you did not know of this particular POI that you need to use, which was the one that was here before this. right? Now, scenarios why when this one does not hold are scenarios where you will see market creating this, right? For example, market creating this mitigation block and breaks out, and this structural move, right? This pullback that you see here comes into this region before buying. Market has mitigated this block already. This mitigation block now would not be valid for you to take trade off. As you see this, there's a clean gap, right? When we saw this breakout, there's a clean gap. Market did not, this is even smaller time frame. There's a clean gap even on the 15 minutes time frame. Market did not come back to this region. It avoided it and go. Coming back now, it is unmitigated. Right? Situations where market has tapped into this already and moves, right? It means the mitigation block has already acted to push market upward to continue the movement. If it's coming back there, it's unmitigated. It's now mitigated, so you will now be looking at, right, your order block for entries, because market has tapped into this region already and has pushed out. Right, market has tapped into it, violated it, and has pushed out. So if it's coming back down, it's going to break it and tap into now your order block. But in scenarios like this where market rejected and left it unmitigated, the market is coming back to it. Reactions can happen there for movements to the upside, right? So this is how most times you will not be able to see it every time, right? Because of other things you might be passing through. So you just need to take your time to master them and look at them so that you don't call this, you don't just look for a wrong way to read it. Okay, so I think that will be all for this video. So you can watch this, and I've talked about this previously in the past, when I talked about point of interest, how to look for a point of interest, POIs, mitigation blocks, and other blocks, right? You want to watch it so that you don't miss entries, right? So guys, I think that will be all. Make sure that as you're looking for entries, do not always forget your liquidity concept, because that is the major aspect of SMC, no matter where you're trading the market of. If there's no structural, there will be engineered. If there's no engineered, there will always be structural there before you take that trade, in order not to get what? Induced. And you must always take trade off what? If it's premium, if you're selling, it should be in the premium zone. If you're buying, it should be in the discount region. You will get more precise entries from there. So thank you very much, guys. See you on the next one.